You know what? I was just reading the statistics and it shocked me. 20% of businesses fail within the first 2 years. 45% of businesses fail within the first 5 years. And 65% of businesses fail within the first 10 years. Only 25% of businesses make it 15 years or more. Now, I dove deeper on this specific article, and one of the number one ways why businesses fail is due to access to capital. And being from somebody that comes from a funding background, this kind of just shocked me because more than ever today, there is more access to capital, more ways to get business funded, more than ever in history. I wanted to make this video to kind of give you all the options. If you've ever been frustrated because you've been denied for funding for your business, or you just don't know where to start or even what to do, or are you tired of using your personal savings account, or even using your equity out of your property to fund your business? My name is Brian Otieno, and on this video, we're going to cover all the different options that are available for you, and I'm going to come to you from a personal experience, and I've actually written a book about this. 3 Paths of Lending. 3 different ways, and I don't care how much money you're looking for. You can be looking for $5,000 or $5 million. There's only 3 ways on how you can get funded. And on this video, I'm going to talk to you exactly what the 3 different paths are, as I call it, the products available for each one of these paths, so you can better understand the different options that are available for you, so you don't face this tragic end by your business failing because of lack of capital. Okay? So again, hopefully on this video, I'll give you enough information so you can be able to position yourself for funding. Okay? I don't want your business, your great idea, to suffer the same fate as what I just mentioned, those businesses that failed. So let's go ahead and get started. Let's first off start by describing to you what our 3 paths of lending approach means. Number 1, you need to understand, okay, that there's only 3 ways lenders will lend money to you, okay? And I'm going to get much deeper here in just a moment, but lenders lend money based on number 1, credit, number 2, income or revenue, and number 3, assets. That is it. It does not matter how much money you're looking for. If you're looking for $1,000 or $1 million, lenders lend only based on those 3 things and 3 things alone. Okay, and I just want you to understand that, because you have to put yourself in the mind of an underwriter. Okay, I am tired of business owners approaching lending blindly. It is critical for you as a business owner to understand the different options that are available for you. And again, that's why I wrote my book, and I'm literally giving my book away for free, limited time offer. There's a link in the description how you can get a copy of my book, 3 Paths of Lending, where I go even further. So now let's talk about the different products that are available within each one of these lending paths. And this is when I'm going to give you the tips here as to what is available for you. So let's first off talk about credit-based path. In the credit-based lending world, and this is number 1, these are accounts that even startup businesses can qualify for. Okay? Number 1, when we're talking about net accounts, net 30, net 60, net 90, net 120. When we're talking about vendor accounts are accounts that are issued by vendors that can only be used at that specific vendor, like Quail, Granger, Accurate, Office Depot. They offer vendor accounts, vendor lines of credit, okay? Vendor credit lines where you can use at that specific store. Then you have fleet accounts. Fleet accounts are accounts that are given to you where you can purchase gas or any kind of transportation needs that they use. Even startup businesses can qualify for these cards. And what I just mentioned to you, regardless of your credit, even if you have bad personal credit, you can still qualify for those accounts. I'm going to leave some links in the description so you can know about these accounts. And again, they will help you also quickly build business credit, so you can no longer have to depend on your personal credit to finance your business. The next thing is you have business credit cards. Now, business credit cards, especially if you're a startup business, some of them do require, majority of them will require that you personally guarantee them. Now, the beauty is, literally, when you personally guarantee it, they're just looking at your credit to pull an inquiry. After that, the line of credit will not report on your personal credit. It will only report on your business credit. So you can quickly start building that business credit. So again, in the near future, you don't have to depend on your personal credit to finance your business. So now we just talked about net accounts, we talked about vendor cards, fleet cards, and business credit cards, okay? Now let's talk about traditional lines of credit. Okay, actually, now let's talk about the second path, which is revenue-based lending. On the revenue-based lending, these are now programs that are designed to extend funding to you based on how much income is coming in, or even some of them, how much potential future income, as you will see as I talk about them here. Now, on the revenue side, we're talking about revenue term loans, SBA loans, we're talking about merchant cash advance, factoring, purchase order financing, even revenue lines of credit. These are all programs designed to extend funding to you based on how much income that you're generating. Let's make it make more sense. For example, like a merchant cash advance is a loan generally offered by merchant processing companies, or even lenders these days offer merchant cash advance, where they will look at your credit card processing statement and they will extend a loan to you based on how much you're processing in credit cards. Okay, a few companies that will do this, as long as you've been in business for at least 3 months, are like Cabbage, PayPal, Square Cash. I will leave the link in the description below. This is something that you have to have access to. So now, those are merchant cash advance. There's also revenue term loans. Revenue term loans are loans that are given based on a percentage of the revenue. It's a straightforward term loan, 3 years, 5 years, maybe even a year or so. It's a fixed rate, solely based on a percentage of the revenue that the business is making. It could be as low as 10 to 15%. It could go as high as 30 to maybe 50% of the annual gross revenue that the business is making. There's also SBA loans. These are loans that are issued by the Small Business Administration. They are fixed. Some of them require collateral, some of them don't, but majority of them do require that you actually offer proof of income. Some of them that a traditional, revenue line of credit. This is where you can actually get a line of credit with true cash access. Okay, unlike a credit card, a line of credit will have true cash access. Okay, or you can tap into that, even the cash of it, solely based on how much income that your business makes. Next, you have what we call factoring or purchase order financing. Let me explain the difference between the two, because a lot of people confuse these two funding options. Number one, let's talk about factoring. Factoring is something that is used a lot in the construction industry. In the construction industry, you have people that accept contracts, let's say government contracts, pool contract, whatever it is, okay? Now, they get paid in phases based on how much work they have completed. They do not get paid for uncompleted work. Now, of course, for them to actually complete the work, they have to pay for workers, they have to pay for supplies, they have to pay for all of these things, okay? And sometimes the company does not have the money to do so. So what they can do is they can approach a factoring company, and the factoring company will extend funds to them so they can use as they're working on the project. And whenever they get paid from the actual client, that factoring company will be paid back, okay? It's money based on future potential revenue, okay? Now, we have purchase order financing. Purchase order financing is very similar to factoring, but not really, okay? Because purchase order financing, the work hasn't even been done yet. Purchase order financing is, let's just say, for example, you own or make candles. Let's just use that as an example. And it's almost Valentine's, and Walmart has ordered a million versions of your candle. And you need, let's just say, for the sake of the example here, you need maybe $200,000 or $250,000 to get the supplies needed to go ahead and satisfy that order. Okay? So now, in this scenario, if you don't have the funds, you can actually approach a purchase order funding company where they can go ahead and look at that purchase order that you receive from a credible company. Okay? They put a lot of emphasis on where that order came from to see how much they can extend to you. They will actually look at that business credit of that company that offered you that purchase order to see how well they pay their bills. So literally, whoever makes your order can affect if you can get funding or not, okay? They can now extend to you a percentage of that order, 70, maybe 80% of that order, so you can get the supplies needed to go ahead and actually fulfill that order. And then when you get paid from your client, they will take a percentage of that. Again, these are the different ways on how you can fund your business. And hopefully I've given you some different examples. And my goal here with this video is to give you all these options, because when people get denied, when they walk into a bank, sometimes you're getting denied because you applied for the wrong funding type. You applied for the wrong option. And most people just go home and they don't even understand, because majority of the decisions today are made by computers, okay? The people at the bank don't even understand why you got denied or whatever it is, because they don't even understand these things that I'm sharing with you. So hopefully I'm bringing it down to a way where you can consume this and actually understand this, so you can know based on your particular situation what you can actually qualify for. Okay? Now, lastly, let's talk about asset-based funding. Now, clearly, these are funding options that are given to you that collateral must be placed, okay? We're talking about equipment funding. If you bring it down to the personal funding world, like auto loans, or even mortgages, home mortgages. In the business world, equipment financing, commercial loans. We're talking about real estate loans. These are all different types of funding that there has to be a specific asset in place. You can get funding either to purchase that specific asset, or you can have a particular asset and you need funding, and the lender will allow you to do what we call a cash out, where you can cash out. They will give you money, but collateralize on a specific asset. So again, let's just summarize it. There's only 3 ways. I want you to understand this. There's only 3 ways on how you can get funded. Either based on your credit, either based on your income, or either based on your assets. These are the only 3 ways. And whenever you're seeking funding, you need to position yourself for funding and consider what funding option is best based on your particular situation at the time. Should you be going after a credit-based funding? Should you be going after a revenue-based or an income-based funding? Or lastly, should you go after an asset-based funding? Okay? And this way, you don't have to waste your time, have a bunch of unnecessary inquiries on your file, which is going to lower your score. You can actually know where you stand, okay, before you fill out an application. So anyway, hopefully you appreciate some of this content. I will leave my book, link for my book down in the description. On my book, I talk about these 3 different ways on how you're going to get funded, but I go deeper, okay? I talk about exactly what the underwriter is looking for, what the pros and cons for each one of these funding products. I talk about exactly even the fees that are associated, and even how to communicate with the lenders and how to submit your application with each of these funding options. And there's a bonus chapter on there that I talk about how to manage your credit. Because again, credit, especially personal credit, personal and business credit, but much emphasis on personal credit, is a great compensating factor for all of these funding options. If you want to get the best interest rates, the best funding options, and maximize your funding power, you want to make sure you have good credit, okay? So anyway, I appreciate your time today. Do like the video, do subscribe, and as always, I'll see you in the next video.